So I've been asked to talk about tariff and trade war. This is a little bit different presentation than I normally do. I will say I don't think I have ever put a presentation together that I was more worried that there was going to be a news announcement 30 minutes before I presented that was going to change everything I should have said. So this has been a very fluid situation. I'm going to try to talk about how this relates to what's going on and what we need to be thinking about as we go into the 2019 crop. As we look about this, I found this cartoon on the internet the other day, and I thought it was great because we've got the President of the United States and the leader of China in a standoff. And when you were a kid and you watched those John Wayne movies, you knew it was a tense moment when they were both drawing for their guns. And in a lot of ways, trade wars are like that. It's a game of chicken. You battle it out and you see who's going to blink first. And that's what we're dealing with. Now, the other note that I will make, what is this trade war about? I think the first thing that I would say, it's not about ag. You may not believe that, but it's not really about ag. It's about patent protection. It's about trade in other goods and commodities. And ag is being sucked into another battle. Okay? But any country in these trade negotiations knows that when you get hit, you hit back at the other country where you can hurt them the worst. And in our case, it is in ag, because we send a lot of ag products to China, and at the end of the day, they knew, for political reasons and others, that hitting us on the ag side would be the place where they could put the greatest pressure on the United States. And it's a game of chicken. And going forward, we're in that process, and that's where we're at. And I think that we're going to continue to be in this process for a little while at least. Now, hopefully if I say that, they'll all settle it tomorrow, and then we'll go back to our normal life. But Larry has set us up in terms of some of our trade relationships with China is an important deal to us as producers and the prices that we receive in this country. Now let me give you, this has given an old economist a chance to teach a little bit of policy theory again. A tariff is nothing more than a tax on imports. And at the end of the day, one of the things that you all need to understand in this process is that there are other players that get hurt as well. A U.S. tariff on Chinese steel cost Chinese steel producers, but it probably drove up the price of the car I bought last month in some form or fashion. So we pay a price as well on the consumer side when you do this. When the Chinese put a tariff on our soybeans, U.S. farmers suffer. The Chinese citizens who have, the millions of Chinese people who now can afford to consume a little pork are going to pay more than they would have otherwise. So there is pain on both sides of this, and ultimately this is all about a fight over protecting intellectual property, protecting and trying to protect certain aspects of the economy in both countries. Now, when we start looking at the situation with tariffs and NAFTA, there's a slide here that I like to use. I hope you can see that on the right-hand side. But this is a graph that goes up through 2015 showing the top 5 markets for U.S. exports, okay? And the blue portion of the top part of that, the top layer of that graph is Canada, part of the NAFTA agreement, and then now the new agreement. The green portion is China. The yellow portion is Mexico, okay? So we have been in trade negotiations with these big 3 trading partners in the last 6 months. Okay, so we've had a lot of balls up in the air at the same time in terms of trade between countries that we do a lot of trading with. Now, if you add up all the rest of the world, it's bigger than those combined. And I think I'm going to allude to this a little bit later on, is that we're going to see some changes in who we trade with as long as we stay in the same context we are now. This is another graph that I like to share, and a lot of you are probably familiar with part of this, but what I'm trying to reinforce here is the percent of U.S. ag production that is exported, and how much our agricultural economy in the United States is dependent upon exports. So you can see some crops there. Cotton, 76% of our production is exported. Sorghum, 59%. Rice, 55%. Soybeans, 50%. Wheat, 46%. Pork, down to 21%. Corn, 21% of some of our bigger commodities. This is a big deal. We have developed an agricultural sector in the United States that is predicated on our ability to trade with the rest of the world. And a lot of our increases in our row crop prices in recent years have had to do with the fact that you had a customer like China and some other places in the world whose economy had improved to the point that they might be able to consume a couple of ounces of pork per day. And when you take a couple of ounces of pork per day and multiply it times millions of people, it changes the demand for our product. And so in China, for example, with their pork production and using our soybeans to feed those hogs. The big 5 crops that we have exported to China over recent years have been soybeans, number 1, $14.2 billion historically, coarse grains, hides and skins, pork, and cotton. Okay, this is for the 2016 year. And so you've seen the growth over a decade's time. Our growth in exports to China had grown from 6.7 to $21 billion worth of ag products. So again, the importance of China in our market. With soybeans, trades, and tariffs, again, I'll show another graph, and this is pre-tariff war with China, our situation with exports to China. You see the red portion of that bar chart, how it's blown up over time, and that reflects the fact that the increasing amount of our soybeans going to China. And so that makes it such a big deal. So when we have entered into this trade war with China, of our agricultural commodities, soybeans have been the dominant story. It's not the only story, but it's been the dominant story as we've gone through here. Okay? Now, this relates back to what Larry was presenting earlier. This is what really concerns me as we sit here. We're facing an ending stocks problem on soybeans. We look at the level of ending stocks that we're looking at coming into 18-19, and we're about to have a huge backlog of soybeans where we have a lot of stocks and we're running out of storage. Now, it could be worse. We could be in North Dakota, okay, for a lot of reasons. It'd be a lot colder, a lot of other things about being in North Dakota. But I talked to somebody in North Dakota the other day. They're piling their grain, they're piling their beans on the ground out there. They have filled up their elevators, and guess what? And I didn't realize this. Most of their beans were being taken by rail to the West Coast and sent to China. Okay? We are modifying who we sell to. So we're selling less to China. We've been selling more to the European Union and things like that. And these North Dakota soybeans have nowhere to go. And of course, they're further from the Gulf of Mexico, and so it costs more to transport them down the river. Before I forget it, I will just suggest that in terms of tariff compensation, I have a suspicion, I know there has been a push to do some kind of regional adjustment. If we do another round of tariff compensation, I think we probably will, that I think there's going to be some effort to try to mitigate the damage in regionally more than they did in the first round, okay? And so that's where we're at. Fortunately, we've got a poultry industry in this state that will consume a lot of our crops. We are near the Gulf of Mexico, where our crops can move out of the New Orleans port and go other places besides China. So while we're being hurt, and I'm not saying that we haven't been, we could be hurt worse if we were in other parts of the United States. Now, we did a little work in the department looking at these tariff payments, this compensation package that was put together by USDA, and you see for soybeans, corn, and cotton, the disaster rate that they came up with a few months ago was $1.65 a bushel for soybeans, 1 penny for corn, 6 cents for cotton. Of course, you got paid half of that amount. And so this is an estimate that we did back a few months ago of how much compensation might flow if everybody that was qualified participated. And we looked at the NAS acres in the state and estimated production. And so we're probably looking at potentially $95 million of compensation to the soybean industry, not very much for corn, $21 million for cotton. Okay, so the big question becomes, are we going to have a second round? And I think that is going to be a bit of a conversation. But let me talk a little bit about the damages. So we did this an evaluation of how much damage had been caused by the tariff. And I've had some conversations with people this week, and one of the things that I will suggest to you that we didn't fully take into account is discounts and things have changed in the state, and that wasn't fully reflected. But we're showing, based on numbers from FAPRI and in terms of the long-term price outlook and things, those of you that went to school here and took an Ag Econ class and learned about elasticities and hated it, well, I'm going to talk about elasticities again. But what we're talking about is a scenario that we show probably the value change due to the tariff on the low side is 35 million and the high side 46 million. And again, I'll caveat that if you've been getting dinged up on quality issues and things like that, that's probably not fully reflected in these numbers here. But what I do think that given the tight scenario that we have had in terms of net, if you take the return, the price times the yield of a crop and subtract off the costs, and we're in an environment where those numbers are already tight, and you start twiddling around with how much people are getting per bushel for their soybeans or another crop, it gets to be problematic. And that's where we're at today, is that we're looking at some pretty significant negative effects in terms of percentage terms on net returns. You know, if you lose $5 and you were going to make $10 an acre, you lost half of the net returns on that acre. And that's kind of what we've been looking at. Now, is there hope going forward? I found this, I apologize, I didn't give a reference on this. I think I got this off Bloomberg yesterday. This shows side by side of the U.S. statement and the China statement after the G20 meeting last week. If you look at this carefully, the bottom line is I don't think those two statements exactly match up. I think we are sitting here looking today at a soybean market that has moved about 15 cents since that announcement. I think the futures market is probably sitting there discounting they're taking a wait-and-see attitude to see if China really starts buying some beans. If they do, then I think the market will move further. If the market really believed this, I think it would have moved further than 15 cents. It moved a little more yesterday, so it may be gradually doing it, but I think a lot of people are taking a wait-and-see attitude towards whether there's really going to be a change, and so we've just got to watch that play out in the next few weeks. What's next? A few let me start by stepping back a little bit. You know, we really haven't changed the amount of soybeans in the world, and that's why the balance sheets that Larry was talking about earlier really matter. What we are doing is changing the flow of where these crops go. So we're seeing soybeans going to the European Union. We're seeing soybeans going to South America. I guess they're coming off the boat before they might get back on the boat and go somewhere else. Maybe even head west. But what we're going to do is that we're going to see that our U.S. beans are going to take a discount in that process. And one of the things that why did the beans and our commodities flow to the various places around the world that they did, is because it was the least cost path for those supplies to get to the demand. What we're doing because of the political situation is we're disrupting the natural flow, the fact that the North Dakota beans were going by rail to the west and so forth. That was the least cost system. Now, if this all were to stop tomorrow, what happens? I don't think that the fundamental economics of transporting grains and cotton around the world have suddenly changed. I think there would be a tendency, if we stopped all this fight tomorrow, to return to the type of flows that we had had in the past. But there's always the worry that when you open the door to a competing country to trade with somebody who had been your major partner, are they going to get kicked back out the door or not? And I think that's a really good question, and I think there'll be some of that, but we don't know to what degree. How long will the effects last? I think that's another question. I think typically when we see these kind of cases, there is kind of a gradual return back to normality, but it may take a while. And there may be some lingering effects along the way. I saw this morning, the Secretary of Agriculture is talking very strongly about we don't want to be as dependent on China as a buyer for our product as we have been in the past. To a degree, we can diversify, but again, China is such a huge market relative to the rest of the world for some of these commodities that we might capture somewhat greater share in other countries, but ultimately China is this enormous market, and these other markets may develop over a longer period of time. Okay, what about future tariff payments? I already alluded to this. The Secretary is talking about the possibility of these. I think there is likely to be something. I don't know what it's going to be, other than I suspect there may be some tweaking around. Corn has complained pretty vehemently that they didn't like a 1 penny payment. I think there will be a push by some to do the regionalization, so that may be something to watch for. And I think we're likely to hear something out of the USDA in a matter of days or weeks on that. Now, let me also throw in that we've done a new trade agreement with Canada and Mexico, and there's been so much going on in the trade world of late that we've kind of, this was a big deal in a way that we renegotiated NAFTA, but that's kind of old news now, even though it's really not very old. I think the main thing that I would say for ag, and probably the good news out of the USMCA, is that it didn't change a lot for ag. And I think for a lot of folks, the concern was, would we harm ag in this process? And so a lot of the key provisions are going to stay in place. I think for most of our products here in Mississippi, I don't think there was any harm. I also doubt that there is a huge upside to it as well, maybe at the margin in terms of that one. But that is a program that probably benefits other sectors more than it does us. But there are some things in there, and I guess my summation of this one is we're probably at least as well off as we were, and maybe a little bit better off. Let me kind of wrap up by putting this all in context, and I think Larry had another version of this same chart. You know, I did get the opportunity to go work on the Senate Ag Committee during the last Farm Bill. After it was over, I figured out, and so did everybody else, that I was too old to work on farm bills, and be trying to write something at 3 a.m. in the morning. And so as we look at the context that we were in, as we wrote that farm bill, and we knew, as we wrote the 2014 Farm Bill, we had been at some really high commodity prices, good times in the ag sector. We knew where we were headed, and we knew that we were headed in the direction that we have gone. You see that since our highs of net farm income at the U.S. level, over $120 billion in 2013, we're down to, I think the current forecast by USDA is $66 billion. We have tightened up. We've tightened up nationally. We have tightened up here in Mississippi as well. So this is my outlook for farming in 2019. You can do it, but you better have your helmet on. Okay? Go for the cheese, man. Go for the cheese. But you better protect yourself in the process. So in addition to the cost numbers that Larry put out there, one of the things I like to do, and I know I've got these different commodities on the same chart, and the scale is kind of tough to look at here. It doesn't fully reflect things. This is a 5-year trend of futures price expectations. And for 2015 through 2018, these are the springtime futures prices for the various commodities. And what I've included for 2019 is that I looked at the futures markets 2 days ago. And I actually tweaked the soybean number yesterday because the market had moved. So where are we at? As we go into the 2019 year and we look forward at what the futures market is telling us for harvest time next year, we're looking at cotton prices that are pretty stable from where they have been. In 2018 we started out at 75 cents. We're looking at 77 cents for harvest time next year. When we look at corn, we were at 386. We're just a shade above that at 394 today. We look at soybeans. We've gone down for 2 years in a row. We're sitting there at 954 today. Again, I think the tariff situation is the cloud hanging over that market. When we look at rice, we're pretty much holding near where we were this time, or in the spring of 2018. So, what's my story here? My story is flat or down a little on the price side for all these commodities. I think that's what we're looking at as we go in there. And then you need to put these kind of numbers with the budget numbers that Larry was talking about earlier. And I think that is probably, unless the futures markets move significantly, that's where we're going to be at when we're talking to bankers this winter. If we're going to be given the opportunity to flip back and forth between ARC and PLC, and this is probably most relevant for crops like corn and soybeans, Do not assume that the payments that you received from ARC in the last 3, 4, 5 years are what you're likely to get going forward. Do not look backwards on those programs because of the moving average. And what we're going to find is that there's going to be a real critical tipping point between ARC and PLC, especially on corn. And if we get the opportunity to change every year, you might flip every single year. I could see that happen.